Well, chances are pretty good you've seen for sale signs in your neighborhood. And if you're planning to sell your home, you may need a refresher on the tax consequences. That's what we're talking about today with our financial advisor, Elaine Beadle. Elaine, good to see you.
Thank you.
So if we've got a viewer wanting to sell their home, how do they determine if they owe tax?
Well, if they haven't sold a house in the last 20 years, the rules have changed. It used to be as long as you replaced your house with another house, you could just continue to roll that gain or that profit on and then have an exclusion at the end. Things have changed. Every time you sell a house, you need to calculate your gain now. So for example, if you bought a house for $150,000, you added a new room for $15,000, you paved an unpaid driveway for another $5,000, that $20,000 gets added to your basis, so your base is $170,000. If you sell it for $200,000, you've got a $30,000 capital gain.
So do you pay tax then on that $30,000?
Well, it depends. There are exclusions, and the exclusions are for a single taxpayer, $250,000, and if you're filing a joint return, it's up to $500,000 that you can exclude. So that $30,000 in our example, you wouldn't pay tax on.
So what are the requirements to exclude the gain from income tax?
Well, there are 4, and so you have to meet every one of them. First of all, it must be your primary residence. In other words, it can't be a vacation home, a second home somewhere. It can't be a rental property. You have to actually use it as your primary residence, and you have to have lived there, or excuse me, you have to owned it for 2 years, okay, at least 2 years, and you have to have lived in the house 2 of the last 5 years. So if you had happened to move but you still own the house, if you meet that qualification, you can still do it. Plus, you could not have used that credit or that exclusion for at least the last 2 years. So for someone who's active in selling a house of their primary residence every 2 years, they have this exclusion available to them all the time. And there's actually a few exclusions. So if you're required to sell your house and move somewhere else because of employment or because of health, or for what the IRS calls unforeseen circumstances, then that 2-year rule can be changed.
So it sounds to me that most people probably wouldn't owe any tax.
Right. But the point here, though, is that you have to calculate it now every time you sell your house. So it's not like just at the end when you decide, okay, I'm moving into a retirement center and then get a one-time exclusion at the end. You have to calculate every time and look at what that gain might have been. But you're right. I think for the most people, it will be a washout. Now, there might be an exception for some people who bought a house in the recession that we just had and maybe got it on a short sale for very inexpensive. Then they're going to have to keep all of those improvements that they made and add that to their basis, but maybe there's a possibility there.
All right, good tips from Elaine Beadle, and of course we've got more from Beadle Financial on WTHR.com.